An options premium can fluctuate with changes to market expectations of future volatility. These changes in implied volatility, or IV for short, can be harnessed with options. So in today's video, we'll explore strategies to potentially profit from changes in an options IV. Before diving into the strategies, let's lay down some foundations, starting with IV. Implied volatility represents the market's expectation of how volatile an underlying will be in the future. The higher the IV, the higher the extrinsic value and cost of the option, and vice versa. Understanding this will allow you to gauge market expectations of an option's price and select from the option strategies we will explore today. Trading strategies based on volatility requires a method for assessing whether an option's premium is cheap or expensive relative to its history. IV rank is a common metric that can be used to measure IV and select an appropriate option strategy. IV rank compares the current IV to its one-year history. It ranges between 0% to 100%, where 0% represents the lowest IV reading and 100% the highest IV reading over the past year. Generally, when IV rank is below 10%, traders might deploy strategies with positive vega exposure, long options, and potentially profit from an expansion in IV. Whereas when IV rank is above 50%, they might trade strategies with negative vega exposure, short options, and potentially profit from a contraction in IV. Typically, corporate earnings and macroeconomic events are the primary drivers of changes to IV. The IV in option premiums can begin rising well in advance of the announcement and experience a volatility crush post the announcement. Volatility crush refers to a sharp decrease in implied volatility, leading to a rapid decline in option prices, often occurring after anticipated news events or earnings announcements. It is one of the most traded volatility events by options traders. Additionally, understanding options Greeks is critical to trading these advanced strategies. Delta is the theoretical estimate of how much an option's value may change given a $1 move up or down in the underlying security. Vega measures the amount of increase or decrease in an option premium based on a 1% change in implied volatility. Theta represents, in theory, how much an option's premium may decay each day, with all other factors remaining the same. For trading volatility, understanding the relationship between delta, theta, and vega will not only help with strategy selection, but also help you manage risk. As a rule of thumb, volatility-based strategies seek to provide a higher degree of exposure to vega while minimizing exposure to delta. The higher the ratio of vega to delta, the more efficient exposure you will have to changes in IV. The ratio of vega to delta helps maximize your direct exposure to IV changes while minimizing the impact from price movements. Additionally, option sellers have positive theta exposure, where time works in their favor rather than against them. Before we explore the strategies themselves, let's review how traders derive an IV outlook to trade. These strategies are exposed to changes in implied volatility to potentially profit from them. Each strategy offers a unique approach to capitalize on the anticipated change in implied volatility with varying degrees of exposure and risk. We'll start with vertical spreads, which have limited risk and potential reward. Vertical spreads are typically entered for their directional and time decay exposure, but will also provide some vega exposure. Overall, they offer modestly efficient exposure to changes in IV with limited risk. We will review both debit and credit vertical spreads to help you understand what environments are suitable for each strategy. A debit spread strategy is used in low IV environments, where you expect a rise in IV. It provides positive vega exposure, negative theta exposure, and also positive delta exposure. This translates to a strategy that will benefit from a rise in IV, but the passage of time will work against it, and it will have significant exposure to movements in the underlying asset's price. Credit spreads, however, are used in high IV environments, where you expect IV to decline. It provides short vega and positive theta exposure, and a sizable delta exposure as well. This translates to a strategy that benefits from a decline in IV and passage of time. However, the exposure to the underlying can potentially benefit or work against the profit and loss of the position. Overall, vertical spreads are a limited risk way to gain exposure to changes in IV. However, they're not the most efficient strategies for trading volatility due to their relatively large delta exposure. This is because, to have sufficient vega exposure, the strikes of a vertical spread have to be sufficiently apart, which in turn then also carries some delta exposure. As we venture into the deeper end of the pool, we encounter straddles and strangles. What you'll see is that both strategies provide significantly more efficient exposure to changes in IV, but they come at a cost. Let's start with long straddles and strangles, which are used when IV is low and your expectations are for IV to rise. Both long straddles and strangles have very significant positive vega exposure, since you're long both a call and put with virtually zero delta exposure initially. However, because you're long both a call and a put, your theta exposure is also doubled, which works against you as time passes. For this reason, a long straddle and strangle are typically held for a very short time horizon to minimize time decay. On the flip side, short straddles and strangles are most commonly used when IV is elevated and you expect it to drop. Both strategies have very significant negative vega and positive theta exposure, which benefits from both a decline in IV and the passage of time. And your delta exposure is virtually zero initially until the underlying moves significantly lower or higher. Because time is working in your favor, a short straddle and strangle are some of the most common strategies to gain exposure to IV. The primary downside to this strategy is the unlimited risk nature and the large capital requirements to hold onto a short straddle or strangle. Overall, options provide a unique opportunity to potentially profit from changes in implied volatility, even if the underlying doesn't move. These are typically more advanced strategies that provide exposure to vega with minimal exposure to theta and delta. We hope this video has provided you with an understanding of how you can trade changes in IV and the spectrum of strategies for it. Visit bmo.com/online investing to get started.